Hello and welcome to the Stansberry Investor Hour. I'm your host, Dan Ferris. I'm also the editor of Extreme Value, published by Stansberry Research. Today, we'll talk with my good friend, Tobias Carlisle. He is a true blue value investor, and I'm going to find out how he is handling the market downturn. In the mailbag today, questions and comments about platinum, gold, silver, Hugh Hendry, and a cautionary tale from listener Greg M. And remember, you can call our listener feedback line, 800-381-2357. Tell us what's on your mind and hear your voice on the show. For my opening rant this week, let's talk about valuation and market bubbles. That and more right now on the Stansberry Investor Hour. Valuation and market bubbles. What in the world is he talking about? Well, it's simple. We are at the point right now where, of course, the big indexes are all down. S&P 500, NASDAQ, Russell 2000, Dow Jones Industrials. It's feeling very much like a bear market, although by the typical benchmark, only one of the indexes, the NASDAQ, is in that kind of territory. So S&P 500 isn't quite there yet, but it's trading like a bear market, and lots of stocks, especially in the NASDAQ, are down 50, 60, 70% or more. The thing is, at this point, down 70% doesn't mean it won't be down 70% more. I know it sounds crazy. You're like, wow, down 70, 80%, it's not a bargain. Yeah, that is exactly what I'm saying. And I think a good example is the ARK Innovation Fund, right? That thing is down 70%. And I think it could easily drop, it could fall in half or another 70% from here. It's loaded with garbage that has never been consistently profitable. Most of it burns cash and makes no profit whatsoever. They lose money, those companies mostly. So you can't, here's the problem, and here's my message for today. You can't reference any kind of valuation meaningfully by looking at the last, especially like 5 years. What happens in a bubble, or even just, it doesn't even have to be a bubble, just a big bull market. The valuations near the top of it just get so stretched out of shape. It's like looking in a funhouse mirror. And the problem is investors are looking in this funhouse mirror, and you're really 5 feet tall and you look like you're 10 feet tall in the mirror. And you start to forget that that's not reality. You think, well, that's the new reality. I'm 10 feet tall. And then one day somebody shows you a real mirror and you're 5 feet tall again. And you're like, well, I'm not that short. I'm 10 feet tall. I've learned that I am 10 feet tall over the last 5 years. And so your point of reference gets all skewed out of shape. And, Wall Street analysts look at stocks and they go, well, this stock was trading for, 70 times sales last month. And now it's only 50 times sales. And we think it should trade at 60 times sales. And it's just crazy. The threshold for, I call it the what were you thinking threshold, right? Because of a quote from a guy named Scott McNealy, who was the CEO of Sun Microsystems back in, the dot-com era. And in 2002, after the bubble had burst, he came out in a Bloomberg interview and he said, look, what were you thinking? You didn't need financial analysis. You didn't need anything to tell you that paying, and at that time, he said 10 times sales. At the peak in 2000, Sun Microsystems was like $64, and I think it bottomed out at like $2 or $3 or something. And he says, what were you thinking? At that price, to get your money back in 10 years, we need no expenses, no taxes, no anything, and just pay out all our sales and dividends to you, and, every year for 10 years. So it's just, you just have no idea how distorted your picture of market valuations is at this point. And so, people start to say, hey, man, this stock is down 50, 60, 70%. It's got to be a good buy, at this point, right? Well, if you're talking about Costco or Berkshire Hathaway or even like Starbucks or whatever, I don't know, McDonald's maybe, something like that. Yeah, maybe, right? But even they could have more downside because, as a bear market progresses, people have sold everything they felt like they had to. Everything that underperformed, let's just say, all the garbage. They sold all the garbage. And then after a while, things keep going down. They panic and they're like, I have to sell what I can now because I can't sell this other stuff. It's already down 80, 90%. So they start selling the good stuff. And I don't think we're quite there yet. We're starting to get there, though. So you get this view of things like, well, if stocks are down 50, 60, 70%, I can buy them, but you can't. You're still looking in the funhouse mirror. And that is the thing that kind of trips people up. I think it probably accounts for the face ripping rallies that you tend to get in bear markets where the market is up, 50% real quick after it's dropped, 30 or, just crazy numbers. The market drops 30% and then it rallies back 20 or something like that, whatever. And in the end, it's like Jim Rogers used to say. I don't even have to know the exact quote because he's said it so many times. It's like markets can go higher than you would ever imagine, and they can fall farther than you would ever dream. So, the thing to do, oddly enough, after the big indexes are down, at this point, just like 10, 15, 20% or so, is not to start looking for bargains necessarily. If you find them, great. You know me, I've always said this, no matter what the market's doing, if you find a really attractive, long idea, good business, you think it's way too cheap, you really have little choice but to buy it. And we have found an extreme value for the May issue coming out this Friday. We actually have found one that I think people are going to keep going to this business and buying their products no matter what. In fact, I think they might even buy them more. Just because that's the way it works in a recession. When you do, you can't afford to do one thing, you'll do another. And this stock is the other that people will do. I don't want to give too much away, obviously, because my paying subscribers don't even know what it is yet. But, that's my message today. And if you just look at a chart, just to try to put some numbers to this, I've got a chart of the S&P 500 price to sales ratio back to 1990. Right. And there was a recession, 1990, 1991, and it went down to like just call it 0.7. I'll do round numbers, 0.7 times sales. Then from there through to the top of the dot-com bubble, it ran up to 2.3, just call it, times sales. And then in the financial crisis, it fell to, again, around 0.7, just call it. And it spent most of its time, while we weren't in a bubble, sort of between 1 and 2 times sales, most of the time. And then, of course, like around 2017, 2016, started getting up to 2 times sales, then crashed in 2018, crashed in the COVID crash of March 2020, down to 1.6 and down to 1.8 or so in the December 2018 timeframe. But then what happened? Like full-blown post-COVID crazy bubble valuation peaked up at like 3, just call it 3.2 times sales. Never been this high in its history from the beginning. Effectively, this is the most observed stock index in the world. You can say U.S. stocks were never this expensive. Where is it today? 2.5. It's hard, that's still in major, higher than any previous high, right? Higher than the dot-com high, higher than the high in like February 2020. We've come off that much, and we're still above those all-time peaks, right? So that gives you a little flavor of what I'm talking about. There's still all kinds of downside left, even though the valuation has come off quite a bit. So, don't get too excited. Be careful. I'm not telling you not to buy stocks. If you find a good deal, you should buy it. But what I'm telling you is that if you're looking at something that was 40 or 30 times sales and now it's like 20, be careful, And certainly if you're looking at the crazy software type or, just meme stock, insane valuations, be really careful. Don't buy that stuff. Your frame of reference is off. What were you thinking territory in those tech stocks is like 10 times sales. And they were 50, 60, 70, and maybe they're only 20 or 30 now and they look cheap, but they're not. Okay, they're not. Be careful. This is the problem in a bubble. Your frame of reference just goes bananas. You don't have one anymore, and you don't realize that you don't have one. Try to reorient yourself to reality. Okay, try to understand the degree to which our human flawed ability to perceive these things has been just horribly distorted by the biggest bubble in the history of markets, in my opinion. All right, I'm going to leave it there. That's the message. Now, let's check in with a guy who knows all about valuation and who only buys stocks when they get good and cheap, Tobias Carlisle. Can't wait to talk to him. Let's do it right now. Gold just passed $2,000 an ounce, setting the stage for a historic new bull run. Multiple billionaire investors are loading up on gold, including hedge fund founder Ray Dalio and real estate mogul Sam Zell, meaning now is the time to own gold. One precious metals expert is stepping forward with a big prediction. He believes we could see gold reach as high as $3,000 by the end of the year, possibly higher. Find out why and get instant access to his number one gold investment for 2022. It's not bullion, an ETF, or a mining stock. In the past, folks using this same gold strategy could have been able to make nearly 50 times their initial investment. Considering how quickly the price of gold has been moving, you don't want to waste any time missing out on the gains he believes are in store for this investment. To get a copy of his new free report with all the details, simply go to www.goldmania2022.com. Again, that's www.goldmania2022.com for a free copy of his new report. Time for our interview. I'm really looking forward to this. We haven't had Tobias Carlisle in the program in quite some time, and it's really good to have him back. Tobias Carlisle is the founder and managing director of Acquirers Funds, LLC. He serves as portfolio manager of the firm's deep value strategy. Tobias is the creator of the Acquirers Multiple. He is also the author of the books, The Acquirers Multiple, Concentrated Investing, Deep Value, and Quantitative Value. Tobias has extensive experience in investment management, business valuation, public company corporate governance, and corporate law. That is a mouthful. That's a lot of stuff for one guy.
That's a long bio. How are you, Dan?
Yeah, good to have you back.
The one thing that I should mention too, I manage two ETFs, the Acquirers Fund, which is ticker ZIG, and the Roundhill Acquirers Deep Value Fund, which is a small and micro fund. Ticker is DEEP, DEEP.
Got it. Do I dare ask how they're doing this year?
They're down a bit with the market, but not as badly beaten up as everything else is. Because I tend to buy higher quality value that has excluded energy. And likely everybody listening to this knows that energy is the only thing that's worked this year. So it hasn't worked.
Right. Okay. Fair enough. So I've got my phone here, and I'm just noticing that The only green on it is VIX, bonds, and gold, and all the rest is red. I don't know if you can see that. It's all
You're a real,
red.
you're a
Red, red, red.
sicko if that's your portfolio.
No, not my portfolio.
If
That's
you're doing
my
well,
watch list. Okay, that's just sort of watching all the markets fall and fall and fall. And so, Tobias, what I'm doing is I am gathering various perspectives on this state of affairs that we find ourselves in, with all the big indexes down and some some names down, 70, 80%, like huge amounts. And like safe names like Netflix or whatever. I mean, are down quite substantially. So I'm talking to traders and macro guys and everybody, and I was like, I know who I need. I need Toby Carlisle on here to talk about value and find out how he is weathering this kind of growing storm. So how do you feel? What are you doing, and how are you doing, and what do you got for us in this mess?
I don't think it was completely unforeseeable. I think that nobody knows what the market is going to do, and today could be the low, could rally 30% from here, could fall 30% from here. But I think over the last few years, it was clear that those techie growth names and all the beneficiaries of the pandemic kind of shut down. They all mooned, as the kids say. They went to the moon, and now they've all safely made it back to Earth. Some of them did it. Some of them did it with at impact. It reminds me of that joke of Elon Musk's where he says, "I want to die on Mars, just not on impact." I think a lot of them have come back to Earth. Some of them are pretty high impact. I don't think there have been any fatalities just yet, but all of those sort of pandemic names have come back, and I think that was sort of inevitable that was going to happen eventually. Last year was a better year for value than we've seen for quite a while, because that was sort of the beginning of that reversal. I think probably ARK, Cathie Wood's ETF complex is the poster child for that. Moonshot and then return to Earth, and now she's underperforming the S&P 500 and Buffett and various others, which is kind of heartening for a value guy like me. I've been saying for a while I thought the market's expensive, and if you look at the ratio that I prefer is what I call the acquirer's multiple. That's why all of my stuff is called acquirers, which is basically operating income versus what you pay for the whole enterprise, so that's the market capitalization plus any debt that you've got to take on, and then you get the advantage of any sort of cash that you hold. So that's what you're paying. Compare that to the operating income. The things that are cheap on that basis still remain exceptionally cheap relative to the market. And in fact, they're as wide now relative to the market as they have been at any point through the entire data series that I have going back to 1992. And that includes the dot-com peak, which is kind of extraordinary. So we're at this exceptionally wide spread to the market. And, what happens in the past when that has reversed course is that it's been a very good time for strategies like mine and investors like me who favor that sort of flow. So I'm incredibly optimistic about the next 1, 3, 5 years. At some point, we'll find a little bit of traction here. So right now, what I'm doing is just going through finding all of the names that I think can survive a sort of nuclear winter, because I think that the techie names are kind of now waking up to this, that it takes a long time for the private stuff to get marked to where the public stuff is. So the VCs haven't had to mark their books to the public stuff. But I hear rumors and I see on Twitter that seems to be starting to happen. So they won't be able to raise capital. So that'll be true for everybody else as well. The public markets will be closed. So you need to be able to generate your own free cash flows. You need cash on the balance sheet. And you need to be trading at a reasonable valuation. And you need a business that can survive through this sort of what we're going to go into. So that's exactly my bread and butter. I cannot wait for what's going to happen. And so I'm just trying to find all the things that can do those things right now.
You mentioned the VCs, the venture capital world, and I'm just looking on Twitter. I saw this. Jesse Felder posted a Financial Times chart of this venture capital monthly returns of the Refinitiv Venture Capital Index, and it's just been brutalized. It's like a minus 24% in April. It's just getting destroyed, and you can see like it's like minus double digits 3 of the last 4 months. It's kind of hard to see the data points, but I think 3 of the last 4 months minus double digits, and April being the worst of them. So, yeah, I hear you on that one. It's
I was just going to say, I think you and I have fairly similar strategies. I think we're both hunting for the same kind of stuff. Sorry, I didn't mean to cut you off there.
No, that's right. We are. But I think we're, to your point about venture capital, I think we take some of the same cues too, because it's sort of like, you go back a year ago or so, right after the ARK fund peaked, and you saw a lot of these things just coming unglued. Like everywhere you look, like all the bubbles were popping, SPACs and cannabis and the growthy
NFTs,
ARK thing. Yeah,
crypto.
NFTs. Yeah. Yeah, there's the funniest article on NFTs in Wall Street Journal as we speak, and I think the first sentence is like, many NFTs are simply not worth what they, what they were when they first came in. I mean, it was just like, no
That's
kidding,
mild.
no kidding. Um, NFTs are, and even many cryptos in general, man. That's the one we'll look back on. It's like the many .com businesses that did die on impact, right? You were talking about that.
The NFTs were technology looking for an application, looking for a use case, and I don't think that there was much intrinsic value in the JPEG itself. And that what that sort of Ponzi scheme style thing needs is a whole lot of new willing participants coming in the front door. And if you look at the Google search trends for NFTs, it peaked at 100 in November last year, and it's at 23 right now. So that's gone away. So in some senses, I think that game is over. And I just wanted to see that. I wanted to see the audit trail on like Beeple Crap's sale, because he sold that $69 million JPEG, which kind of kicked this whole thing off. But I'll bet you that there were two parties who knew each other and just crossed that on the tape, and then that's ignited this whole NFT silliness for the last sort of year or so.
Yeah, and that wasn't the only one he made millions on, or that sold for millions. I'm not sure he made millions every time, but yeah, crazy, crazy, crazy business. But it's funny because there's always some, like these bubbly, crazy things don't happen just because people are crazy, right? There's the speculation is rooted, and the enthusiasm and the soaring valuations, it's rooted in some truth, right? I mean, like the .com bubble was people getting excited about the internet, which is a really super exciting thing that happened to us. It's just a matter of making money with it, and being a disciplined investor. It just makes all that more difficult. But as far as the technology goes, it is exciting to watch, right? I mean,
I was in Omaha over the weekend for the Berkshire annual meeting, and it was interesting hearing Buffett talk about the night that he was on his honeymoon, and he drove with his wife from Omaha to Vegas. It's that famous story where he walks onto the floor and he sees, people have spent lots of money and they've flown from long distances. People fly in from Australia to go to Vegas, fly 20 hours to get to Vegas, just so they can go and play games that don't make any kind of economic sense, like where you sort of, if you play long enough, you're basically guaranteed to lose. Yep. And he turned to his wife and he said, I'm going to make a lot of money. Like, if you could just be a little bit economically rational when everybody else is being irrational,
right.
At least you're not going to lose any money.
Right.
That much I can say.
Yeah. And, I was talking with my friend Greg Diamond, and he's a trader, and we always get back to that, especially with the traders, don't lose money. Risk management. What is, so maybe tell our listeners what risk management means for a guy like you. You know, if you're Buffett, you're walking into the casino, you know you're going to make a lot of money, and part of that is because you know you're not going to lose. You know, the way those gamblers are losing and losing and losing. And how do you know that? What do you do to prevent that?
Well, first, that's my entire process, really. Like, that's the very first part of the process. And that is the idea that we're really looking for things that we can't lose on. So I think for many prospective investments, really what you're looking at is that's the first stage. How much money can I lose in this investment? And I think that excludes the very vast majority of things that I would consider. And there are lots of ways that you can lose money. One of them is just paying too much for something. So you and I would go through and do a valuation, and we would have a valuation range for what something might be worth. And probably I might distinguish myself from other value investors in that I would look at the most conservative end of that valuation range. And I had previously sort of been a liquidation style investor, and I'm not a liquidation value investor anymore. I'm prepared to look at the operating business and come up with a value for the operating business. But that's the first thing, is this thing trading at a discount to a really conservative estimate of its value? And if it is, then I would go on and look at, does it have a balance sheet that can survive whatever sort of happens in the future? Or is it basically, does it have too much debt? If it's got too much debt, then that's another way that you can die. Is it a business that's the equivalent of kind of taking all of the down, like, writing naked puts? Does it have that sort of downside risk where, so for example, like credit card companies famously tend to go through these periods of time where people can't repay their credit cards, and that's a bad business to be in, particularly at the top of the cycle. And the problem is they often get really cheap right at the top of the cycle because everybody else knows what's coming too. So there's lots of business. So that's the sort of the process is, first of all, that is the first part of the process, and then I make sure the valuation is right. I make sure the balance sheet is right. I make sure it has that business model that can survive. And I want to make sure that the management is the kind of management that's not trying to sort of gouge your eyes out. They're the ones who are, they're on your side when the market falls over. What they're going to do is buy some stock rather than, or repurchase stock for the business, more importantly, so that, they're not the kind of management who'll try and take it private when it gets beaten up. The kind of management who'll help you out as much as they'll help themselves out. And really, if you apply that filter, there's not a lot of stuff that gets through the filter. And those are four pretty simple things. You just want someone who's got reasonably honest management. Like, that alone excludes about 95% of businesses that are out there, I think. You look at the salaries that some of these guys are on. I looked at the Twitter, the lady who does the Twitter, the censorship at Twitter. She's paid $17 million a year. I was kind of blown away by that. That's a big number. That's CEO money. That's quarterback money.
That's quarterback money. Yeah. Yeah. It seemed crazy to me too, but I don't know. If you're right. Once you start going down that pathway, you are excluding a lot of public companies, a lot of them, because it just, it snowballed, right? People started giving stock away as compensation. And so, the compensation at the top just has mushroomed into this gigantic, in my opinion, dramatically overdone thing for what are overwhelmingly just like professional managers for hire. They're not, like Chris Mayer would call them owner operators, Chris Mayer, another value investor we've had on the show.
I love those owner operators.
Yeah. Yeah, there aren't many of those around.
No, there aren't. I wonder if that 17 million for the Twitter censor, I wonder if they could have got someone for 9 million. Just chop it in half. I'd do it for 9 million. I'll have a go at it for 9.
Yeah. Yeah.
I couldn't do a worse job.
That's right. I know. Never mind the amount. Let's look at the nature of the work that you're being paid $17 million for. It's a little bizarre. It borders on Orwellian, in fact.
Right.
So, what do you think, though? Do you think Elon will actually make, the changes that he wants to make? And I think more to the point, will Twitter become a better business? Will they see growth in revenue per daily active user?
I don't think Twitter could become a worse business. So I think that he's starting from the absolute bottom of the barrel. I've said to lots of people, if you were just halfway sensible, if you had any common sense at all, you could run this business really well. Like, this business just needs clear rules about what you can say and what you can't say that doesn't favor one political persuasion or another.
Mm-hmm.
Just make the algorithm public, which is what Musk has said that he will do. And then, work on the advertising side. That was so he's buying it. I think he bid. Did he bid 45 billion? Was that the final, or 48 billion?
I think it winds up. I think it winds up being right around 44 billion. But yeah, ballpark. Yeah,
44. Okay. So then you compare that to Facebook, for example. So Facebook is a $500 billion enterprise, down from $1 trillion enterprise. And so he's got lots of headroom there. You really don't have to, I don't think you have to do much he could double the value of that thing with very little effort, and it would still be sort of under-monetized or undervalued. I think that Twitter, in some senses, is a more valuable asset than Facebook, because I think that it is more likely to survive. Everybody has got that ick about Facebook that they've shared too much over the years. I don't go onto the Blue app anymore. I haven't gone onto the Blue app for 5 years. I'd have no idea what's in there. But I'm on Twitter every single day because I use it for my business. It's the best news feed in the world. It's a great way to market your business. I've got my own podcast, so I do a lot of. You want to hear about something Orwellian that happened? So YouTube, because I published my podcast to YouTube. YouTube sent me a note saying you're not allowed to talk about the Ukraine-Russia conflict and suggest that the Ukraine invited. And they used these words. They said you're not allowed to victim blame the Ukraine. You ever heard that term used in relation to a country before?
No, I don't. I've never heard the term victim blame like that as one. But this is insane.
It's craziness. What? I mean, it's Putin's a bad guy. I'm not saying Putin's not a bad guy, but it just seems crazy to me that they're taking sides. Like, you can't aerate that problem at all. You can't even discuss the issue.
Yeah, that is crazy. I read something else that got a little more scary to me today. It was this article about PayPal and how PayPal, it's by Matt Taibbi, so it's going to be.
I saw that one. Yeah,
yeah. So PayPal decided that this company consortium could not use the PayPal anymore because it didn't really what it amounted to, in Taibbi's opinion. PayPal didn't like consortium's politics anymore, and it shut down their account, and there was $9,000 left in it, and PayPal took the money as damages. No judge, no jury, no judgment, no anything. They just took the money. And I was like, wow, the slipperiness. We're not walking around slipping. We are on our ass sliding down the hill, and it really, I talked about this with Kevin Duffy too. Maybe you feel the same way. Let me know. I used to think, well, we're sliding down that hill. It's made for a war of words. And it's not like when I go there, I'm clicking off all the ads. I'm like, get this ad out of my face. I came here to tell my enemies they're stupid. You know what I mean? It's just, how's that ever going to be a better business?
It's sad. It's sad because we've had this well-established principle through Western liberal democracies that the process was the most important part of it. Whatever you felt, clearly there's at least two sides to there's at least two political persuasions out there. There are many, many more than two, but there's at least two dominant ones. And each one vehemently disagrees with the other one. And the only way we're able to live together is if we have this, we have this process. We have this very clear rules of the road. And we just seem to be overriding those to make sure that our particular morality is the one that succeeds. And I think that that's an extremely dangerous slope.
Corporations, they have to say what they need to say.
Engagement is great for the algorithm, so that they don't mind people being angry with each other. I turn on all the safety stuff. So if someone if someone doesn't follow me and they leave a comment, I don't even see it. So it's nobody can do the drive-by, strafing and just keep on going. And they get to say their piece, but I don't see it. So I don't really mind, because I found that there was quite a lot of that going on here. There are people who must have some sort of search on for some form of words, and when you use those words, they come in and it's a bot or something like that, and the bot has their kind of little bit of vitriol loaded up to say. And so I don't find it particularly helpful or useful. It's not a great format. It's whatever it is, 280 characters for expressing nuanced views. That's always going to be fairly tough. But I agree with you. It seems that there's I don't understand why these companies feel the need to descend into the political discussions, particularly given that most of these things have at least two sides to them, and each side can have an honest principle. They can have good reasons for why they believe what they do, even though they each disagree with each other. And there are lots of debate. I don't want to raise any of the debates on this show, but there are lots of debates going on right now that are particularly sensitive. I just wouldn't want to be on one side or the other. I just think it's craziness.
Yeah, it is crazy. I was going to say, you sound so rational.
Do you think I should go and apply for that job?
Yeah, right. No, they'd be like, "You're way too rational, dude. You're too reasonable about this. We need hardcore. We pay $17 million for hardcore, anti whatever it is. These days, I think it's anti-conservative. It'll change, believe me. And that's another thing.
Well, that's the risk. You get someone in there who's got control of it, who's got a set of views that agree or disagree with you. That would make me as scared. If the person on there was saying everything that I really wanted to hear and censoring every other point of view, it would occur to me that somebody else could get in there and change that around, which you would think that would concern them a little bit. Evidently not.
And you would think that these, corporations that we're talking about would be concerned about alienating half of their customer base. They don't seem concerned about that. I find it, in the beginning, like I said, well, they just want to not offend. So they're not really, they are kind of expressing a view. Maybe it's a little sort of a liberal or progressive view, but they're just doing it to make sure everybody understands that they're okay with whoever you are. But now it's gone so far, I feel like they're in danger of alienating, swaths of their customer base. Huge swaths.
Well, I think they've already done that. I think that Netflix is a good example of that. I think that there are lots of people who who don't have a Netflix account because they don't like the politics of the shows that Netflix runs. I have one because my kids watch the cartoons, but aside from that, I don't really spend a lot of time watching it because I just don't like any of the shows. The shows just aren't very good. When Netflix got cut in half, like my activist proposal to Netflix would be just go and make some shows that people want to watch.
Yeah.
That's bold.
It's bold. You're saying a lot of bold, reasonable stuff here. How is a bold, reasonable fellow like you able to make a living in this kind of a world?
You got to keep it all to yourself, Dan. That's the key. Got to have that disciplined Twitter account.
And it makes sense that you're a value guy too, right?
To be fair, the very vast majority of people are right in the middle there and do think that all of this is pretty silly. Like when the pandemic was at its peak and all of that sort of silliness that they were carrying on, that ahistorical, anti-science, like quasi kind of Marxist stuff that they were carrying on with, most of the conversations that I had with people were, this is crazy. But you couldn't say anything on Twitter or on YouTube or any of those places because you'd be, demonetized or excluded from the public square, which is like, does the Republic really want that sort of stuff happening? This has been, one of the great experiments in Western liberal democracy that the world has ever seen. And you can go back thousands of years to like ancient Athens, the birthplace of democracy, or other places like that. Here we have this incredible experiment. We're really going to let some tech companies from San Francisco mess the whole thing up, like in the course of like 5 years.
Apparently we are. I don't know. I hope not. I certainly hope not.
It does seem that way at the moment.
It does. All right. So maybe
we should talk some investing.
I was going to say, let's shift this thing into another gear. So maybe I could get you to, I'm very curious with each guest at this point, like what is your portfolio look like? Is there more cash in it than usual? Is there something different that you're doing now that you don't do most of the time in response to the way markets have behaved so far this year?
I don't really know what the market's going to do. So let me get that out first. So I think I said earlier, I don't know if it's going to rally 30 or fall 30 from here. And I've done enough sort of testing, trying just about everything I can think of, moving averages and valuation changes and all these different sort of ideas that I can get into the portfolio to test whether I can find an optimal kind of cash to equity allocation. I've never been able to find one. All I've been able to do is what I have found is the best strategy has always been to remain fully invested. So asset allocation is a question for where you are in your investment, in your own life cycle, your own career, how close you are to the end. That sort of should dictate how much cash you hold, your sort of risk tolerance. It's not really a question of where you think the market's going to go, because you're invariably going to be wrong. You just can't pick it enough times and get it right enough times. The best return you're going to get is being fully invested. What that means is you get more volatility, but you get better returns over the long run. So I'm fully invested. That's not hard for me right now, because I think that value is in the kind of companies that I'm looking for have never been this cheap relative to the market. And I'm talking about a dot-com peak as well. Now, the market is likely to come back a lot, but probably that's the case. Although I don't know. I don't actually know. I think that probably when the historical methods like using the Shiller PE or that Buffett metric where he looks at the size of the stock market relative to GNP, or the Tobin's Q one where you look at the replacement value of assets versus the market value of those assets, they all seem to indicate very substantial overvaluation. The problem with that is, I'm to be fair, I that's where my bias goes. I do feel that we're very overvalued. But the argument on the other side is when you go and look at the composition of the index, there's Google as like the top weighted companies in the index. It's Google, Microsoft, Amazon. I think it's still Netflix, like Facebook. There's a list of those top 10 stocks. And you look at those companies, like we've never really seen anything like that. Like they earn gigantic returns on investment. They grow incredibly rapidly. And, there's a range of valuation there. Microsoft is probably more expensive than the rest, but even like they're sort of reasonably valued. You wouldn't be, you couldn't hang a man for kind of holding those names right now in the proportion that they appear in the index. Like you would think that's a pretty good portfolio, I think, to hold some of those names. So I could make a case that the index is sort of reasonably close to being reasonably valued. Now, if the 10-year goes from 3% to 6% from here, that may change some things. But where else are you going to hide in the event that occurs? So that all of that means that there are some companies in that are out there that I think are deeply undervalued, throwing off plenty of cash. They don't need to go to the markets to get any financing for the business. If anything, what they're doing is they're taking advantage of the fact that they're so deeply undervalued. They've heard the message from the market, which is, when you're deeply undervalued, you should liquidate. That's what the market's telling you. You're too big. And the way that you liquidate is by buying back stock. And so that's what they're doing. And that's what I love to see. So if I can find a company that's buying back stock, it's too cheap and it's still growing reasonably, it's not going to need outside financing, then I can fill a portfolio of those now. I could fill 2 portfolios of those right now. So I'm fully invested long through the mid-cap, large-cap, small and micro, both sides of that index. And I'm very happy with those portfolios. I think that the forward returns from those portfolios are about as good as I've seen.
Yeah, I mean, any kind of measure of value to growth that I've seen or that I've made myself, you're back to at least 1999-ish as far as the attractiveness level of it goes. It's better than it's been in a long time, and it's a relative assessment.
And that spread is wild.
It's a relative assessment, though. Like, I feel like we had more absolute cheapness in those stocks, 3 years ago or so than we do today. but I don't know if it matters because, the businesses are still great. Money is going to go somewhere. And they're, like you say, they're buying back. They're cheaper than ever. I mean, it's just, it's a fantastic setup. And it's all across, like, you know, um, commodities versus stocks, value versus growth, um, emerging markets or ex-US really versus US. That whole sort of other stuff versus dollar, it's just it's more attractive than it's been in a long time. And I think, I but you said you don't buy. I wanted to touch on this. You said you don't buy the oil companies, so you don't go for the commodity-based businesses.
It's not that I don't buy them. It's just that the metric that I favor is that acquirers multiple, which is an operating income to enterprise value metric. So what that means is that I won't buy them until they start cash flowing, and and I think that the best time to buy the energy companies was probably when oil went negative. Negative $37 a barrel was a pretty good contrary indicator to go and load up on energy. But I had owned a little bit of energy before that, and they all looked pretty gnarly through that. And I don't really know when. Oil is incredibly difficult to forecast. It's just, even Warren and Charlie were saying that they're the two worst oil investors around, which is, Warren bought China National, and I think he's six bag on that one, and now he's bought Oxy. So there's some pretty good indicators that probably energy is too cheap. There is some energy. I will likely be buying some energy in the near future, and so I haven't bottom ticked that one, but that's just because I require them to start flowing before I buy it, because who knows, negative $37 oil, like that was crazy, but there's nothing to say that wasn't going to continue. And as we've sort of, to continue along on the theme that we've been discussing, there's that anti-ESG attitude towards oil and energy. I don't really know. Like, I'm just not entirely sure what the impact of that is. So probably, when anti-ESG attitudes towards energy were at their peak and oil went negative, that was a very good time to buy. And I think now that we're all stepping back a little bit from that, because we recognize that you need energy to power the entirety of the economy and need cheap energy to do it. And we're seeing right now the consequences of underinvesting in energy, because energy's up a lot, and that seems to be the thing that's spiking the whole of the economy. That's why everything else is down. Cheap energy would be a great thing to have right now, lots of it.
Right, and the more you sort of target, we talked about this actually with Hugh Hendry, because of the political targeting of the fossil fuels has kind of taught those companies to say, maybe we get $1 of capital instead of digging a hole in the ground. We'll buy, like, I think we mentioned Rio Tinto yielding 11%, not in any commodities, right? This is not like marginal lithium demand.
I do think it's funny that all those energy companies are trying to paint themselves as something other than energy companies. Like when British Petroleum started calling itself Beyond Petroleum, like what do you do? We pump oil. What are you calling yourself?
Yeah.
Something else.
Yep. Little crazy. So your portfolio is fully invested. You've got enough names to fill 2 portfolios, you say?
I could, because I size pretty small. I do 3% positions. I just find it hard to tell which one's going to be the better one. So I tend to size to 3, and I rebalance back to equal weight on a regular basis. And so that means I can find 60 names, easy 60 names. I've got 100 names in the small and micro portfolio.
I'm glad you made that point about not, the equal position sizes, because, it's a very popular thing, isn't it? Especially among value people, that we take larger positions in our best ideas. Well, you may think it's your best idea, but you don't know which one would going to generate the highest return now, do you?
That's it. And I don't know. And I like I said, I've got this sort of quantitative bent. One of the books that I wrote was Quantitative Value, and I've written another one called Concentrated Investing. And Concentrated Investing was an investigation of concentration, it's right there in the title, and diversification. And I was trying to figure out what was the best way to form a portfolio. And there are lots of different ways that you can do it. Very popular one, popularized by Buffett, is this idea of Kelly weighting, which is edge over odds. So you figure out what odds the market is giving you for this business, and then you think, what's your private information? What have you figured out that nobody else knows? It's a great kind of way of doing it if you can foresee the future. And unfortunately, I can't do that. So I kind of have to, I use the one where I just equal weight and I say I don't know. And I every time I form a portfolio, I feel better about some of the names than I do about other ones. But I've never been able to pick which one was going to work more than the other ones would. So I've just taken away that right of mine to size up
I've come
the best
to
ones.
hearing that whenever somebody says, Kelly, the Kelly formula, we do Kelly formula. As soon as someone says that, I just kind of nod and, I have to go to the bar, excuse me, and I'm moving on because I just, it's a kind of it's a fatal conceit, I think, for most people. We've seen people, I guess it's easy to pick on Bill Ackman, um, just Valiant and Netflix and just, these huge bets. I mean, just, Target vaporizing billions of dollars. Yeah, Netflix. I mean, just
the list goes on.
Right. So nobody knows.
The thing is, just to go back to what one of the first things we discussed, and that's that, what is your objective? My objective is to survive. The very first thing I think about is risk management. My objective is to survive every single cycle so I can come to the next cycle and then to survive that one too. And that's, if I keep on surviving for a long period of time, everything else takes care of itself.
Yes.
One of the ways that you can kill yourself, this is not the shot selection. So like, we talked before, like making sure that the position is right. This is a portfolio manager selection. Just size too big into something. I see it all the time. I talk to these guys. They're like, I got a 22% position, like at inception, or you've let it grow that big. Like either way, that's too big. My apologies to anybody out there listening. I understand if there's horses for courses. I understand. Buffett's got quite a big concentration in Apple as a portion of the equity portfolio of his insurer. I'm not Buffett. Most of us aren't Buffett. And Buffett's got other cash flows from other things that it doesn't really matter how big that share is because he's got $100 billion coming in over the next few years that he's going to redeploy, and it's going to wash that away a little bit. I think that the best way to survive is just to keep your mistakes small. That there's that great book, Winning the Loser's Game. I think that's really the key. Keep your mistakes small. And that's sort of what I try to do. I just don't know what's going to happen. So I try not to lose too much money in the stuff that, we're already saying these things are undervalued for a reason, right? There's part of the market, a very big part of the market that thinks that there's a problem with them. And for all I know, they're right. Like I literally think that it's a coin flip. It's about 51% in my favor, 49% against me. It's just that the things that work a little bit more than the things that don't work, and that seems to be what generates the returns over time. So it would just be arrogance to say that I can figure out which one's which, and I can't. So I know that half are going to be mistakes, half are going to work, and the ones that are mistakes, we're going to rebalance out of them. We're going to lose a little bit of money, but as little as possible.
Those are beautiful words, actually. They really are, because, like I said, too many people, and like we said, many of whom have come to the market the last couple of years, too many people are going at this like it's some kind of a lottery ticket or something. It's so easy to open a brokerage account. It's easy to hit click buy. It's easy to over allocate to a single position. And so, it's easy to make mistakes. It's easy to make big mistakes, and making small mistakes is you're so reasonable. How did you get so reasonable? You look too young to be this reasonable. I'm serious. You look too young to be that reasonable.
I've been a value investor my entire investing life, so I've been beaten up so many times that I just try to walk that very fine line.
He's calloused. He's hardened, folks.
I think that one of the things you really have to watch out with those managers who have a mistake, like they size something up and make a mistake, it's the next thing that they do, because everybody wants to dig themselves out of the hole with the very next shot. And so often you see guys who have lost a lot of money have a gigantic swing at the next one so they can catch back up. And that's, I think, even if you see someone size it up like that, I think that's sort of time to go. It just shows you that they're no longer risk managers. They're playing some other game. And Ackman's a classic example of that. Ackman just sizes up those. I mean, I think he's one of the world's great analysts, and I just don't think he's done that well as a portfolio manager. The Netflix trade was a crazy one. He was in that big when it was riding really high, and then when it got beaten up, when it's 6 times EBITDA to EV, so not my favorite metric, EBIT, but EBITDA, and he's out. And I sort of thought, well, now it's kind of interesting. Now that it's really beaten up, maybe it's worth taking a look at. I don't know if you want to reflexively punch out of something at that level, but I'm not like he's a billionaire.
That's right, which suggests that becoming a billionaire is about other things maybe than the things we're talking about.
I can't think of anything worse. I don't want that burden.
I agree. I think most people overwhelmingly will handle it poorly. I think most people will handle great wealth very poorly. And people wish that they win the lottery and they go into the market hoping to make a lot of money in stocks real quick. But the truth is, I think that if they succeed, it would be worse than if they fail, because it'll teach the wrong lesson.
I get to do what I love all day, every day. If I'm sensible about it, I get to keep on doing it every day until they carry me out in the box. And so that's my objective, just to keep on doing it. That's why I like Charlie and Buffett, Charlie Munger and Warren Buffett so much, because what those guys really have done is they've got to do what they really like doing their entire lives, and they're very long lives. They're 91 for Buffett and 98 for Charlie. That sounds like a pretty good deal to me. If I can, I don't need to live that long, but if I can keep on doing it when I'm there, then that's
wow.
A gigantic win.
98 Munger is, and he went to Omaha.
And he is razor sharp.
He flew to Omaha. Wow.
Yeah, I did. Yeah, it was fun for the Berkshire meeting. Charlie still has all the best one-liners that I've ever heard. He's such a lad, that he said Warren figured out that he could only ever work for the man he shaved.
Yeah, he tosses out several of those in every meeting. All right, Matt, we've actually been talking for a little while here, it looks like. I want to address my final question to you, because I suspect that I don't know. I've gotten a good answer from you before, so I'm going to do it again. Same question for every guest, same final question, no matter what the topic, and you can answer any way you'd like. It doesn't even have to be about investing. So the final question is simply, if you could leave our listeners with a single idea today, what would it be?
Well, I'm working on a new book, so this is sort of front of mind for me at the moment. And this is the entire purpose of the entire book, and it follows along with what we've been discussing all day long. So the idea is really that the objective of the game is to survive. And so if you think that what I need to do is survive to the next period, then I think that really simplifies everything that you do. Rather than trying to maximize your rate of return, maximize your likelihood of survival. And that means you're going as fast as you can, as safely as you can, but with the emphasis on the safety. And I think that it's been interesting. It's kind of it's influenced my entire life. I've started driving more slowly in the the far right hand lane, so that, and then I just put on my reggae music and just drive along, totally blissed out, totally zenned out as I'm driving around. People are whizzing by on the left. It doesn't bother me at all. So I think that really that's the key, and part of the last few years just so crazy for watching everything run away and then watching everything come back really reinforced it for me that the name of the game is to survive to the next period, and just to keep on doing that, one foot in front of the other over and over again. And if you do that, I think you're going to be okay.
Excellent. Survival. That survival lesson came to me sometime, I guess, in the past few years. I realized how important survival was as a goal. So thank you for that, really. And thanks for being here.
My pleasure.
I mean, it's always great to talk to you, man.
Hey, thanks for having me, Dan.
Yeah, well,
likewise. Love chatting to you.
Let's not wait so long next time.
Well, that sounds good to me.
All right. So I guess it's bye-bye for now, and thanks again, man. Always a pleasure to talk with Tobias Carlisle, a fellow value practitioner, and always an experience in which we get wisdom from him. We get, like he said, a guy who's been in the trenches. He's been a value guy his whole career. He's been beat up. He's survived and therefore has learned the value of survival and learned the value of risk management. Maybe we should just call the podcast the Stansberry Risk Management Hour because we always wind up here, don't we? I think I'll just leave it at that. Let's do the mailbag. Let's do it right now. Last year, when most investors were watching their stocks plummet, one Wall Street legend had an unfair advantage that was identifying winning stocks with massive upside, like Riot Blockchain before it shot up 10,090% in less than 12 months, Digital Turbine before it shot up 789% in 8 months, Overstock.com before it shot up 1,050% in 4 months, and more. Clients have paid as much as $5,000 per month to see this kind of research, but today you can get a glimpse at his system, the Power Gauge, absolutely free. It's a new way to see which small stocks could soon be rated a buy across Wall Street and shoot up. By using a secret so powerful, CNBC's Jim Cramer said, even he doesn't want to bet against it. This Power Gauge comes from the legendary Mark Chaikin. Mark is the creator of one of Wall Street's most popular indicators, a system that appears on every Bloomberg terminal in the world, and it's used by banks, hedge funds, and every major brokerage site. He spent 50 years on Wall Street, survived and thrived in 9 bear markets. 9! Built 3 new indices for the NASDAQ, where he once rang the opening bell. But today, Mark has turned his back on Wall Street and wants to show you how this unfair advantage works. Right now, you can get a free in-depth look at how his Power Gauge system works, a way to type in any of 4,000 different ticker symbols and see exactly where the stock is most likely to go next, and in any type of market. Simply go to www.trypowergauge.com for your free look. Again, that's www.trypowergauge.com. In the mailbag each week, you and I have an honest conversation about investing or whatever is on your mind. Send questions, comments, and politely worded criticisms to feedback@investorhour.com. I read as many emails as time allows, and I respond to as many as possible. You can also call our listener feedback line, 800-381-2357. Tell me what's on your mind and hear your voice on the show. First up this week, I want to relate a cautionary tale sent in by Greg M. And he actually sent it in through the regular Stansberry feedback, but it's worth listening to. And he said, feel free to share it if you think it's worthy. And it is worthy, Greg, I promise you. So it's a little longer than our usual email, but just slightly. All right. He says, hey, Dan, I was thinking about the Musk Twitter deal. It reminds me of similar events in my life I thought I might share with you. As a young man in my 20s and 30s, 1980 to 1990, I was extremely successful and was a millionaire before reaching the age of 30. It seemed I could do no wrong. All of my businesses were flourishing, and I was doing very well in real estate as well. I never paid attention to the markets, as my little world was all under my direct control. Then my black swan event happened. My father passed away, leaving his business in disarray. I stepped in at the wishes of the estate, family, and bank. I had no doubt in my mind that I could turn the place around. I just needed a little time, estimated 2 years. Initially, everything went as planned. Times were tough, lots of elbow grease, but the business was turning the corner. In the midst of it all, the bank blindsided me and demanded collateral to support the business. On top of that, the estate was leaning on the business to keep it liquid during the roll-up. All still manageable, and reluctantly I gave the bank the security they required. After all, I knew I could get this all turned around. Then the unexpected happened, the recession of 1990-91, and the bank called the company's line after only 2 months. Their line of credit is what he means. I immediately faced a, quote, margin call, unquote. throwing a huge wrench into my carefully executed business plan. The bank began seizing and selling off my assets. Cash flow was destroyed, and my whole empire crashed and burned. I tell this story only because it sounds familiar today. Musk has been extremely successful, sometimes walking the tightrope, but successfully navigating while his plans were under his control. My gut tells me that Twitter will become his black swan event, and the lenders will most likely pull the rug out from under him when least expected. And I think this will have an impact on Tesla shares, the collateral. I actually feel sorry for Musk. I understand completely why he does not see this possible outcome down the road. It's pretty easy to become overconfident by basking in the success of the past. And then he just says, ego? I think you're right, Greg. And Greg finishes up. He says, I was quite fortunate and managed to bounce back. I have never trusted nor dealt with banks since. And the event shaped my investment and business approach in most likely an overly conservative and defensive manner. Only time will tell how this unfolds for Mr. Musk. In the meantime, I'm looking at some bear put strategies on Tesla to take advantage of what I see as inevitable. Sincerely, Greg M. I'm going to let Greg's story speak for itself. Suffice it to say, actually, that I have pointed out that, this could be Elon Musk's Ike Batista or Aubrey McClendon moment. Both of those guys were billionaires who crashed and burned because they got too levered up and too confident. Next is Christopher D. I thoroughly enjoyed the recent episode on precious metals, but have a question. What about platinum? I'd love to hear your thoughts. Historically, platinum has been more expensive than gold, but not in recent years. When I look at its fundamentals, it screams extreme value to me. It's rarer than gold, it's harder to extract than gold, and it's undoubtedly more useful than gold. Plus, as a bonus, it's less likely to be illegalized or confiscated. I know that changes in automotive technology in recent years have sharply reduced demand, which is at least partially responsible for its relatively low price. But long term, it seems like a solid bet, and its current relative low pricing creates a nice buying opportunity. But I'm no expert on precious metals, so maybe I'm missing something. Christopher D. Christopher D., I would not necessarily sell myself as an expert on precious metals, although I do know lots of folks in the mining industry, and I've made a lot of recommendations. Well, I've made the same few recommendations repeatedly in the mining and metal space. So what I will tell you, though, as an investor, I see no problem with having a little bit of platinum in your precious metals portfolio. So if you want to hold gold, silver, platinum, palladium, rhodium, a little bit of all of them, I would just remember that they're not as liquid. They're not going to be as liquid as gold and silver. So be ready just to hang on to them and maybe not ever sell them is really how I view precious metals in the first place. So sure, why not have a little platinum in your physical precious metals holding? I see no problem with that at all. And I don't think you need to do a lot of, too fancy analysis about it, because the point is to have hard assets and not sell them. It's not to try to, if you want to try to trade platinum and, buy it at the bottom and sell it at the top, good luck to you. I'm not into that. Not in this context. But sure, why not hold a little platinum? Next is RWR. And RWR says, I'm an Alliance member for 7 or 8 years now and listen to every podcast. I really enjoyed your interview with Hugh Hendry. I agree that he has a unique perspective. And then he gave me some quotes that he liked. Everybody liked the wear comfortable clothing quote from Hugh Hendry. He's just really insightful and always entertaining to listen to Hugh. My question, what are the market forces suppressing the price of gold and silver? Hedge funds, the government, international demand? I don't understand why the rally in precious metals seems very slow. RWR. I hear this a lot. And to me, the way I look at the physical precious metals, it's, I don't quite get this. Like, they are fantastic long-term holdings. They have done a pretty darn good job, as we talked about in previous episodes, of anticipating and continuing to protect against increased inflation. And the fact that they don't go up every time the CPI goes up just means nothing to me. I'm not going to sell them. And so far, gold is a 50 bagger since 71 when it was completely untethered from the US dollar, and it's beat the S&P 500 so far in the 21st century. And, in the shorter term, it's done fine. It's in the 1800s. That's fine. I don't have the same problem that other people have with gold not, being up 30%. It just doesn't bother me at all. What bothers me more is what Hugh Hendry talked about, that Bitcoin correlates perfectly with the NASDAQ. I'm still long Bitcoin, but it bothers me more and more the more I think of it. When is Bitcoin going to become untethered from NASDAQ? When is it going to start exhibiting store of value characteristics? Sooner would be a lot better for us than later. So it's a good question, though, RWR. It's asked often, and I hope my answer isn't too unsatisfactory for you. Finally, this week, Isaac B. from Twitter sent me a direct message, and he says, "For my money, feel free to interview Hugh every week, Hugh Hendry, one of the few who sets aside his agenda to tell the truth." So, Hugh doesn't have this biased political idea where he always has to be betting on gold, or he always has to be betting on stocks, or he always has to be betting on bonds. He really sizes up the situation, and he's one of the more objective thinkers when it comes to what is going on in the world, in the macro world, right? So he's always dealing with those big assets like bonds and other large asset classes. Thank you, Isaac. I'm glad you said that, and I'm happy to share that thought. Last time Hugh was on the show, but a couple years ago or something, people wrote in and they said, "I don't understand that guy. I can't follow him." And this time, Isaac sent me a direct message, and of course, we just had another, favorable comment this week from RWR. So I'm glad to hear that. I'm glad to hear that you're all getting on the Hugh Hendry train, because he's definitely worth listening to. Well, that's another mailbag, and that's another episode of the Stansberry Investor Hour. I hope you enjoyed it as much as I did. We provide a transcript for every episode. Just go to www.investorhour.com, click on the episode you want, scroll all the way down, click on the word transcript, and enjoy. If you like this episode and know anybody else who might like it, tell them to check it out on their podcast app or at investorhour.com. And do me a favor, subscribe to the show on iTunes, Google Play, or wherever you listen to podcasts. And while you're there, help us grow with a rate and a review. Follow us on Facebook and Instagram. Our handle is @InvestorHour. On Twitter, our handle is @Investor_hour. Have a guest you want me to interview? Drop me a line, feedback@investorhour.com, or call the listener feedback line, 800-381-2357. Tell us what's on your mind and hear your voice on the show. Till next week, I'm Dan Ferris. Thanks for listening.
Thank you for listening to this episode of the Stansberry Investor Hour. To access today's notes and receive notice of upcoming episodes, go to investorhour.com and enter your email. Have a question for Dan? Send him an email, feedback@investorhour.com. This broadcast is for entertainment purposes only and should not be considered personalized investment advice. Trading stocks and all other financial instruments involves risk. You should not make any investment decision based solely on what you hear. Stansberry Investor Hour is produced by Stansberry Research and is copyrighted by the Stansberry Radio Network.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates. You should not treat any opinion expressed on this program as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of opinion. Neither Stansberry Research nor its parent company or affiliates warrant the completeness or accuracy of the information expressed on this program, and it should not be relied upon as such. Stansberry Research, its affiliates, and subsidiaries are not under any obligation to update or correct any information provided on the program. The statements and opinions expressed on this program are subject to change without notice. No part of the contributor's compensation from Stansberry Research is related to the specific opinions they express. Past performance is not indicative of future results. Stansberry Research does not guarantee any specific outcome or profit. You should be aware of the real risk of loss in following any strategy or investment discussed on this program. Strategies or investments discussed may fluctuate in price or value. Investors may get back less than invested. Investments or strategies mentioned on this program may not be suitable for you. This material does not take into account your particular investment objectives, financial situation, or needs, and is not intended as a recommendation that is appropriate for you. You must make an independent decision regarding investments or strategies mentioned on this program. Before acting on information on the program, you should consider whether it is suitable for your particular circumstances and strongly consider seeking advice from your own financial or investment advisor.